Now we'll turn to U.S. products and what's happening in the U.S. How has Henry impacted this, and then what does that mean really as we go through the rest of September, now that we moved into kids going back to school, getting back into some sort of normalcy. So one of the things that we want to look at, because we are coming into Labor Day weekend, so there's going to have a long weekend. Typically there's a little bit more driving, not to the same level that there is for July 4th, but again, there still will be more than your average weekend. So we also had essentially some of that demand pulled forward, because when you look at what is so implied demand, or the way or product supplied, is the EIA is looking at what is left from there, essentially from them into the blenders and into the, really into the tankers that then go to the end user. So when you look at what normally happens, you have gasoline getting pulled forward and diesel pulled forward in order to get that, in front of that one last surge. You also had a lot of product getting moved through the system ahead of Henry, which again is leading to some of that moving through the system ahead of schedule. Now, on the other side of that, you will have inclement weather, along large parts of pad 3 into pad 2 into pad 1. As you get that inclement weather, you'll have people doing a little bit less. So you're going to see this essentially big correction to the downside. And by big correction, instead of being at that 16.268, you're going to come back down to essentially 15.2. So we expect it to come below that for the average, which is now crept up to 15.48. And it's just because, typically what we were expecting was a spike in distillate, a spike in jet fuel demand, and then a drop in gasoline. Instead, we got the spike in jet fuel, the spike in gasoline, but then the spike in distillate, the spike in jet fuel, and then instead of seeing a drop in gasoline demand just held firm. So it was up just a small number of 6,000 barrels a day. So when we look at what that means, so what we look at implied demand, so gasoline implied demand was up 6,000 barrels a day. Small, and when you think of it incrementally, but again, when we were expecting a drop to about 9.2, and instead we held at 9.578, you get an idea of just how sizable it is when you look at this total number. Now, we expected to see an increase in distillate by about 300,000 barrels a day. We got 286,000 barrels a day. So right in line, just because, again, diesel's going to remain a bright spot. We don't see that changing. Jet fuel was the one that had the surprise. We were expecting an increase of 300,000 barrels. Instead, we got an increase of 398,000 barrels a day. Again, both of those will come back down. Distillate will remain elevated. Jet fuel will see an oversized correction. And then that'll be some of those adjustments that we'll see over this time period. Again, when you look at 2018, when you look at some of this, you can see that typically we get a little bit of a spike that will always deviate based on when is Labor Day, what is the expectations for Labor Day, do we have a hurricane that is going to adjust some of these flow throughs. So again, this is something which is why we always look at the average, which is still a positive number, but what does that look like on the aggregate? Because when we look at, specifically at gasoline data and jet fuel data, TSA numbers are well below normal. Then you look at departures are down in the U.S. And then when we look at gasoline, when we look at Gas Buddy had us down 1.7%, which is, again, even factoring in Louisiana. Descartes had us down at 9.15 million, which again puts us right where we thought we were going to be at about that 9.2. So that's where we think some of this is going to see some correction and come closer to where we are. And then we'll start seeing some of that seasonality build in. So then when we turn to just distillate, so distillate had a draw of 1.73 million barrels. That's 12.6 million below the 5-year average. But even more so, when you look across the last 29 years, we're right on the 29-year average. So there's still this backdrop of where are we going to go from here? How does this set up? Because when you look at what has happened on the production side, gasoline production was fairly flat in terms of what are the refiners targeting. And then when you look at distillate was down a bit by about 85 basis points to about 30% of the cut. That will get reversed down even further just because this isn't even factoring in the cuts that we saw from pad 3. So again, you're going to continue to see some of these draws, which is actually going to take us below these numbers, and it'll be so you can see that there's typically builds up until the middle of September. Then you start to see some of these draws. We do have strong diesel demand. We do have refiners that are going to be hindered based on some of these aspects. So this will actually be some of these bright spots, and instead of seeing additional builds, we will start to see additional draws. But then when you look at imports, given where we sit on the storage world, you can see that imports came in at 77,000 barrels a day, 201,000 barrels above the the 5-year average. And it was driven by Pad 1, Pad 2, and Pad 5. Pad 1 and Pad 5 being more important at this point, where Pad 1 was up another 28,000 barrels a day. But when you look at it, that's 155,000 above the 5-year average. Pad 5, up 30,000 barrels a day. That's 37,000 above the 5-year average. So you can see how things still remain abnormal when you're looking at the import market, but given the amount of product available and then what the spreads are, it still makes sense to import into the U.S. And given where we sit on the distillate storage side, again, still in a very strong spot. And this shouldn't be a surprise. Here's your increase to seasonally adjusted all-time highs. But on the distillate demand side, we were expecting to essentially just go sideways. So here we were expecting this move either back to, still within the cloud, not back to these outside of it. But now you can see where we normally get these impacts from, not only hurricanes, because this is picking up some hurricane activity, this big drop, but also when you could factor in Labor Day. So we will see some of this drop back within the cloud, still well above the 5-year average, but again, still back within the top end. And when you look at just this turn back up, and we expect to see this continue to stay elevated, not so much go to back to the all-time highs, but we're coming back to a strong period for shipping based on obviously Black Friday, the move for the holiday season. You would have ordered some of this stuff, especially given the delays. You would have tried to front order some of this so it's already on boats, and you'll start to see some of this move through the system. And this is going to keep diesel strong. This is going to keep things elevated in general. But then when you turn to rail traffic, so rail traffic continues to be impacted based on some of these labor shortages, some of these problems. When you look at grains remain strong, not as strong as 2020. But when you look at just the overall backdrop, you'll continue to see some of the strength. One of the things that we continue to see that weakness in is motor vehicles. There's nothing to change that, especially when you look at Ford shutting down 2 facilities for each week at a time. You continue to see a lot of these slowdowns, a lot of these problems at the assembly line. But the one that we continue to see a lot of growth in as we go through the end of the year remains intermodal, given the amount of backlog, the amount of product that still remains to come through the system. And that will keep things a little bit better versus where we were in 2020. Not to say that 2020 was bad at this point, because we're coming into a harder seasonal period, just because there was such a makeup point when you look at 2020 based on the shutdown and then the big increase. So the comps will be difficult, but in terms of historics, we'll still continue to see intermodal very strong, and that'll be supportive as coal is going to remain elevated, grains and grain products. And this is what's giving us that confidence. When you look at just what is happening at the ports, you can see as we get into September, we're looking at something that is 85% above the previous week, 34% above the previous year. And then when you start looking into the end of September, you're talking about 78% above the previous year and even 7% above the previous week. So we continue to see this buildup at the coast, where we have a significant delays across the system, and that's going to keep us well supplied as we look at the intermodal side, as some of this comes through, not only just the rail, but also the trucking, keeping us very well situated. When you look at what the expectations are coming through, you can see essentially Henry pushing the warm weather out, bringing in some of this cold that's going to hit Pad 3 up and through Pad 2 into Pad 1. But then you get a lot of heat in the West Coast. So realistically, when you look at this net, we're going to continue to see a lot of strength out of natural gas world, not because you're going to see a lot of demand in Pad 1, but because you really won't. It's just you're going to see stronger demand out of Pads 3, 4, and 5, but you also have that lost production from the Gulf of Mexico, which will help offset. Now, I'm going to bring it up just because it's a data point. We have to look at it. I'm not saying they're right, but when you look at what the Farmer's Almanac has come up with for their 2021-2022 winter forecast, I know it's September, and we barely know what the weather is going to be 10 days from now. But this is looking at some of their other things in the old Farmer's Almanac. They usually do. They put something out. Sometimes they're right, sometimes they're wrong. Again. But when you look at this in general, you can see that it's supposed to be pretty much cold throughout the country with a decent amount of snow. So when you think about cold and wet and just, cold and snowy, that's going to result in more natural gas demand, more heating demand. So when you look at this coming forward, especially when you look at natural gas now at $4.63, that's also going to support propane. So when you're looking at this chart, this is bullish for natural gas and propane. I am not saying this is right. I'm just saying that these are things that are going to start coming into the market. We're going to start getting these longer term forecasts for what winter is going to look like. And when just looking at this in general, you can see that everything is coming up very cold and snowy and or wet, which is going to lead to additional consumption of natural gas and heating, not only just, but then heating fuel. And when you look at diesel or a distillate at this point, you can see that we're coming into a potentially strong period of demand with not enough product. So again, all supportive for where things are going in general. So then when we turn to gasoline, so gasoline had a build of 1.29 million barrels. That's at 4.3 million below the 5-year average. But then when we look at motor blending components had a build of 80,000 barrels and now is actually above the 5-year average by 500,000 barrels. So that's where we look for that kind of that underlying demand is in that blending components. And again, the blending components still, and this is why it's important, because when you look at the gasoline coming in at 1.29 and then blending components coming in at 80,000, you can see just where when we're looking at this, it's like, okay, well, we should have been lower on gasoline. Like the build shouldn't have been at that level, but you had imports that surprised to the upside, and you still had that increase when we're looking at the increase of pull through from that storage side, but not to the same level based on when we start looking at the underlying, because imports offset that. So we did get that big move, but we do have some of those adjustments in general. So now when we look at imports had a surprise to the upside of 62,000 barrels a day. We were expecting a drop back below 1 million. So what we were expecting in general was a drop below 1 million barrels a day. Instead, we got an increase. So now we're 421,000 barrels a day above the 5-year average, driven by Pad 1, which had an increase of 118,000 barrels a day, We did get a drop in pad 5 of 73,000 barrels a day, but even though we had the drop in pad 5, it's still 72,000 barrels a day above the 5-year average, because we continue to see these imports coming from pad into pad 1, and more importantly into pad 5. And pad 5 is the one that's going to stay strong. It will be lumpy, which we're seeing here, but still be elevated above normal. Now pad 1 is the one that we do have a lot of clean product coming from Asia, coming from India, Singapore. It's just going to be a matter of, does it deviate into Europe or does it deviate into the US? And we did get another increase in European imports. And based on what we're seeing, when we're looking back through the ships coming over, we should have enough to maintain about 350,000 barrels a day of imports from Europe. Even though things are getting a little bit better in Europe, you're seeing some more demand, the margins and the spreads still are going to keep product moving into the US. Now, this is when we start segmenting out what is noise in the gasoline side and what is real. So on the Gas Buddy side, U.S. weekly gasoline demand fell 0.5% last week and was 1% below the 4-week average. And according to Gas Buddy data, Sunday demand fell 0.9% from the prior Sunday and was 1.7% lower than the last 4 Sundays. So again, you're still seeing a very seasonal move down. Excuse me. Then when you look at gasoline demand from Descartes, they had a drop of 1.7% to 9.162 million barrels a day. Now, when you look at what was reported from the EIA of an increase of 6,000 barrels, putting us at 9.578. So Gas Buddy puts us at about 9.15. Then you have, when you look at Descartes, putting us at about 9.16. And then you look at what we have in the EIA coming at 9.578. You can see that discrepancy. Now, our view was we were going to get a drop to 9.2. So which, when you look at the data sets that have come out, we were right in line with where the data is showing us, except we got a big impact when you're looking at what happened from not only just the seasonal move, but also Henry. And that's going to be some of those big pieces that we want to look at, because now the drop is going to be a bit more exaggerated than it really should be. But these are things that we'll talk about next week as it starts to come through. Now, we did get a small drop in gasoline prices, holding at that $3.14. That has since reversed higher. Now we're at about $3.15, $3.16. Still very high for Labor Day. And then once we get to the other side of Labor Day, then we'll start looking at winter grade, because you no longer need to run summer. Now, just this is the caveat. The EPA did issue a waiver for Louisiana, opening up the ability to use winter grade early. That is typically something that happens during a hurricane or during a traumatic event, just because it opens up the pool that's available for people to consume. On the more negative side, we did get a bigger increase in diesel prices, back to $3.34. That, again, moved higher once more since this was released, because this was as of the August 30th, and we can get data as recently as today. So you're still seeing, again, that drive higher. There's still that demand for the diesel side. This gasoline prices, and when you start looking at some of the data sets, that is continuing to eat into what are some of the demand cycles, what are people going to do for the holiday weekend, and you're just seeing people stay a little bit closer to home. For those that are for kids, for parents with children, because of the way the Jewish holiday falls, some schools did start early, so they started this week instead of Tuesday of next week. Because of the Jewish holiday, some of the vacation days were a bit wonky, so they picked up and started a week early. So we did get a seasonal drop a little bit sooner than normal. For those in the South, some of your kids have been in school for 2-3 weeks. This is more of a Northeast, your Pad 1A, if you will, impact. But again, these are things that are going to continue to come through the system and pull down some of that demand. So then when we look at blending components, this is what we've been talking about, not seeing this drop. We've been expecting this to just go sideways, and we continue to see that based on the demand cycles that we're seeing, because remember, blending components goes into and gets fed through the system, and we just don't see the demand. And as we come into these winter season, you don't need the same level of blending components, or at least a different cut of them that are cheaper and easier to make, which will again also keep us very much elevated on that side. Now, when we look at products supplied for gasoline going back the last 15 years, you can see we're still staying strong. We were expecting a drop back down to the 5-year average. Instead, we just went sideways, which just means that the move down now could be a bit more exaggerated. And when you look at that 15-year average, you can see that it typically trends down at that level as kids go back to school. There's less driving for vacations, but our view is that it's going to be even further to the downside, because we do have flexible schedules still out there. We still have work from home mandates from the company side. So that's, again, going to offset some of this capacity, keeping us a bit more depressed. Now, when we look at this capacity here, you can see we're above every year except for 2018, where 2018 you had that pop. But it's all a matter of when do you get that increase? Because remember, as we were saying before, Labor Day always has that, that front-loaded move. So when you look at the previous week, we were well below the normal when you look back through 17, 18, 19. The reason why is because Labor Day fell here. You had that push in general. So now, instead of getting that push over there, the week early, we get it now. But it's not an increase higher. It's just, again, staying at this flat line, because when you typically see that spike and fade, instead it's now flatline and fade. So that's something that we're going to look at to see how does that impact going forward. Again, you're seeing that drop in general. We expect it to come now back below that 2018 level, and something closer to, again, it'll likely come in below 9 million barrels a day. We don't believe that's the right number. It's just going to be, again, that timing in terms of when it's released. And here's why, another point in time that we're seeing some of these pressure points. When you look at parks continuing to fall along that seasonal move, especially when you look at the previous year, we're following that trend. Retail and recreation starting to roll over. When you look at transit stations slowing a bit while workplaces stay fairly flat. Again, these are some of those shifts in general. And then following on that level, you can see Italy, UK, US, Germany, all moving back down, really right in line with last year, which is why when we look at some of these flow through, again, now we've looked at Apple, we've looked at Google, we've looked at Descartes, we've looked at Gas Buddy. That's where you can look and say, okay, well, these guys are saying one thing, and they're all saying the same thing, and the EIA saying something different. So again, it's just more along the lines of the EIA coming back to where we think the numbers are going to go. And then we'll see a steady decline just along seasonal lines. It's not going to be anything surprising to the downside. It's just a very seasonal move lower. So then when we look at propane, you can see we're now below the 5-year average by 17 million barrels. We're below 2018, 2017. We only had a build of 530,000 barrels. That's very low for this time of year. Typically, even in 2018, we had a little bit of a pop. Again, it's going to be a very bullish time for NGLs. And if the Farmer's Almanac is right, we're going to see a lot of pricing pressure at this point in time. So now when we look at the vaccine side and we look at the vaccinations, you can see here that where things remain fairly steady on a positive, the world levels were at about 0.43. We're now up to 0.5. You're seeing that acceleration in Malaysia, Japan, China, all of which is good for the Asian side when we're looking at, what is this going to look like for Q4. And then when we look at this pace in general, you can see, again, things moving in a fairly stable line. U.S. at 52% fully vaccinated, 9.3% partial. That's something that will continue getting us closer to that 60% number. So then when we look at jet fuel, you can see that we're still below the highs, the normal from the last few years, but you can see that we set a new 2021 record for jet fuel demand. We had we had a draw of jet fuel. When we look at the draws in general, we had a draw of 2 million barrels coming out of this period. Now what we're saying is that we're going to get a drop back down, because you can see that we get a spike going into Memorial Day, wrong side of summer, into Labor Day, and that we'll get that drop back down, and we think it'll just drop back down to these lows here of about 1.35, 1.4 million barrels a day of demand. And it's really why are we saying that? Well, you do have the bullish side of what's happening in the Pacific Northwest, what's happening on the West Coast for the fires, but you're starting to see some of that rollover for North America. You're starting to see that come back down in terms of the Americas, but we are seeing some increase in Asia Pacific. So net, we're actually had an increase in departures, where they increased 3.7% week on week. It was really driven based on departures in China, and the U.S. led some growth, but that's starting to come back. But it's really China and the rest, again, that Asia Pacific that is driving some of that. But then when we look forward the next 11 weeks, passenger flight schedules for the 11 weeks ahead declined by 1% since last week. Again, and that's just seeing that seasonal adjustment. So you're seeing those seasonal adjustments, which is why we expect to see that come back down. But when you look at the TSA data, you can see that we've had that extensive move down. You had that little increase for Labor Day. We'll probably get another little peak for Labor Day movements, just depending on when it falls based on the charts. So here you can see that big drop, which is the lowest that we've been at since essentially April. And as we've been saying, it's going to follow these seasonal norms, just at a reduced level, just given some of the pressure points that we've seen in the system. And then when we look at open table, things are starting to decline on the weekday side, which is something that I think is going to, and so instead of being, 10 to 15% below normal, it'll probably be closer 15 to 20%. Again, you're going to get some impacts from weather, just because you had the hurricane that'll impact. But we do see the weekend staying strong, probably 5% higher. Obviously, you're going to have your Labor Day push. That'll keep things a little bit stronger, but you're going to start to see some of that slowdown in restaurants as well, as people can't go outside, go inside, maybe don't want to. Again, these are some of those impacts in general. Now that we've gone through the U.S. products, we're going to go deeper into what is happening in the international and global market.